In this episode, we interview Jaime Rogozinski. Stay tuned. What's up, guys? Welcome back to another episode of the Jeremy Kirsten Show, where every episode we talk about business, entrepreneurship, investing, and personal growth. Today we had the extra special privilege of getting to interview Jaime Rogozinski. Let's just go ahead and get straight into the interview. If at any point you like this episode, please hit a thumbs up, leave a comment down below, and be sure to subscribe if you haven't already. And one more thing, hit the notification bell so you can be notified each time we upload a new episode. Now, enjoy the interview. All right, I think we should be good. All right, guys, we got a special guest with us today, Jaime Rogozinski. He's the founder of Wallstreet Bets, a very popular group on Reddit that is really, Jaime, I guess I'll let you kind of explain it yourself on what this group has kind of turned out to be after you started it.
Well, Wallstreet Bets is a constantly evolving entity. It's definitely changed since it was founded 8 years ago, or since it was created, and we have gone through several stages up until where we're at now, and I have no doubt it will continue changing as time goes on. Wallstreet Bets started as a place for people to go discuss high risk, high return trades. You have a spectrum when it comes to the stock market or the approaches. You have conservative investing, which are very long-term time horizons. They have these diversified approaches, sometimes within stocks and bonds and other combinations of different asset classes. And this is when people think about the market, the traditional way of using it, right? This is the Warren Buffett's, if you will. What I was looking for at the time, I was in my early 30s, I was single, I had decent disposable income, and I wanted to find ways to make it grow. Getting 5-10% annualized returns was just not appealing to me. So I started this and all the places that existed online were focused heavily around these conservative investing approaches. You have some professional traders, day traders that existed, but that's a professional group, and sometimes not as welcoming for beginners. And so created this forum, and I gave it a name, Wallstreet Bets, to try and get rid of or scare away any critics of what exactly took place in that forum. I was okay with having high risk, high return, short-term, high time horizons using stock options or different leverage products, and it was quite popular when it started, and as the years went on, it continued to grow significantly. I would say over the past couple of years, it's experienced some even stronger growth. I think largely because of these zero commission brokers that are coming out. You have a lot of different tools that have become more accessible to people with smaller bank accounts, like fractional share purchases. This is where you can buy just a little portion of a share if it's too expensive. And the groups changed as well from, hey, let's try and grow our money faster using or losing it faster. I guess they go hand in hand, to straight up, let's go ahead and gamble. With stock options, they have the ability. They're fascinating instruments for people to gamble with, because you can do all sorts of different maneuvers. You can really define your risk to a incredible amount, and you can make all sorts of different plays. But some of those plays involve, what they call these scratch-off lottery tickets. They're very, very highly leveraged. You can just take a few $100 or $1,000 and make $100,000 overnight. And so people now are straight up, as if it was a horse race or as if it was a sporting event. They're betting on this thing going up or down. And we've had people make tons of money, and we've had people lose tons of money, as you can imagine with anything like this.
Yeah, it's kind of funny. So I got a copy of your book here for anyone who's interested. Is Wallstreet Bets: How Boomers Made the World's Biggest Casino for Millennials. And you really dictate and explain out kind of my own story and how I found you in the group and Robinhood and options and everything. So just a quick little background of myself. I was it was what, late last year, September, that time period. Actually, kind of the summer before that. I was looking at purchasing individual stocks. I wanted to do that. I didn't know how to, and I wanted to short companies and things like that too, mainly in the tech sector and things like that. And so I started doing some research. I found that you could both buy individual and short individual stocks through Robinhood, because when I initially called my broker, they said that's just not what we do. So I said, okay, I got to find out how to do this on my own. So I started discovering apps like Stash and Robinhood and everything. And so, was able to find individual stocks through there. So that was nice, right? So again, this is that millennial shift of getting away from the large companies and hedge funds and things like that and brokers. And then I got into options. Again, it's kind of just like your book says, you kind of accidentally make money and things like that. So I did a long call, a very short-term one on Tesla one day after it fell 10%, probably from one of Elon's mishaps, right? And then the next day I tried to sell it and I thought I sold it. And I was selling at a bit of a loss, and I was like, whatever, I'll take my losses and I'll go. And over the weekend, Monday happens. I'm sitting in a Monday meeting. I open my Robinhood, and I was like, whoa, excuse me. I ran out of the meeting to figure out on my phone, how do I actually sell this now that this is paid off? And so I accidentally turned, $95 into, it was around, I don't know, $600 or $700. And I thought, I'm gonna get rich, right? I'm thinking, I just do this 6-7 more times, I'm set. And then I quickly learned, as I think all option traders do, is like, it's not that easy, and you can lose your ass real fast. And so, some of those earnings kind of came back down, but it's fun. For guys like myself who are not, very, let's say, formally educated finance guys and investors, like, I don't know what it is about this culture of us millennials, but we found this avenue now, and it's I mean, we're hooked. We're coming into Robinhood, as you pointed out, the number of users is just growing exponentially like crazy. And a lot of that is to, like you say, and these apps making it, I guess, what's the word? Gamifying it, making it real simple. So talk on that a little bit, on how this culture has found these apps and how this is just like, going nuts.
Sure, and that's a great story, by the way. One of the biggest curses the market can provide people is beginner's luck. It's almost a rule of thumb. We just see it time and time again. People walk in, make a ton of money, and then give it all back slowly. I think it's a lot more forgiving when people start off losing money. They quickly learn to respect the market. And either way, that's a great story. So, yeah, I mean, what's interesting with regards to the millennial demographic, and mind you, this book was written before coronavirus. I think that there's a whole other factor that we need to consider. But we have these millennials that, at least the older millennials like myself, we got to see the last financial crisis, and we got to see what it was like for parents or friends or people lose their houses, people try to leave college to get no jobs, to go back and live with their parents. And, everything was blamed on the stock market. I haven't met a millennial yet, or just a young person. We can go ahead and put Generation Z into this as well. That comes to me and says, hey, I would like to have a long-term diversified approach to my retirement fund in such a way that I'm keeping up with inflation, and I'm also putting political systemic risk into, all sorts of different things. They're not thinking about that. The ones that have their retirement plans, they have their Roth IRA or their 401k or whatever they have set up. And some people don't even have that. A lot of millennials don't have houses relative to what previous generations had at this age. And and a lot of them straight up don't trust the market. We saw this year, this was with coronavirus, grant you, but still, we had over 10 lock limits, some up, some down, within 10 days. These are moves that are between 5, 7, sometimes 10, 12%. This is with the stock market that's supposed to be, somewhat stable. This is supposed to not be Bitcoin. This is supposed to be something where when something goes up so much that they have to halt the market, and down when they have to halt the market, it's difficult for somebody to take it seriously. To the same extent, because they didn't have these opportunities to get money, because they are stuck in lower paying jobs or don't have houses, they're looking for ways to also grow their money in a way that's a quick in and out. They're waiting for the next volatility event in order to make money. They don't care if the stock goes up or down. One of the things that I find fascinating with WallStreet Bets, and I did a bunch of podcasts earlier this year before we had that market crash in March, and a lot of people ask me, well, what is everyone on WallStreet Bets going to do as soon as the market crashes? Everyone's going to lose everything. And even on social media and on Twitter, people, the day that there's a big red day, everyone says, everyone's going to get margin called, which doesn't even make sense because most of these guys are buying long options anyways. But my answer was, I think there's going to be some pain because they're all used to seeing the market go up, but then they'll switch their minds, and then they're going to start shorting the market by the use of buying puts. And then they'll make money on the way down. And then when the market turns around, there's going to be some pain and people are going to lose money. But then they're going to change their mind, and they're going to buy calls again, meaning they're going to go long the market and they're going to make money. These guys were making so much money on the way down because obviously when the markets crash, they say risk happens fast. They made a lot of money really quickly, so much to the point where they were cheering these negative employment reports or the different news that was coming out, and it made them feel guilty about the fact that they felt good about the fact that everything was going, that the world was falling apart. And so they started donating their money. They opened up different funds, and they were fine with that. So overall, you have these guys that don't trust the stock market, that are looking for ways to make additional money. The market's providing them everything that they need because of these crazy volatility events, and you have access to the market through these zero commission apps. They give you access to stock options without any verification whatsoever. And and they have actual casinos for those that actually want to really play, like going back into that gamified experience. For anyone that likes to play blackjack or roulette or whatever it might be, even slot machines, those are very inaccessible. You have to drive really far, or you have to be within a certain states. And you have gambling that's kind of been made legal. It's still not clear to me exactly what the rules are with it, because some courts said yes and some no, and that's still being defined. So, but the stock market's open almost 24/7. It's closed. If you trade futures and forex, you only have Saturdays where you don't trade. So, it's the perfect combination. Then comes coronavirus. You lock everyone at home. You take away all their entertainment. You give them all money with stimulus and unemployment. And I read a note that some incredible amount of people moved back into with their parents, at least temporarily, so they're not paying rent anymore. So they might as well have fun using these gamified experience. The interface, to me, Robinhood has been controversial at times because they've had some high-profile events, in which result people losing money. And I'm not talking about the infinite margins and things like that. I'm talking about events where they're not allowing people to trade, or it goes down, or they prematurely close their positions. People continue to use Robinhood because they love the interface. When you go in to buy a call option, it asks you, do you think the stock's going to go up or down? And you answer with an arrow. That if that's not a game, I don't know what is. You try to explain a stock option to somebody, that actually explain to them what it means and how it works and the mechanics behind it. And it's not a simple thing. It's not an arrow up or down, but the Robinhood allows you to do it that way. So I think it's just the perfect combination.
Right. I think I might have lost some of my video here, but we'll just continue rolling with this anyways. But so I guess overall, with that gamification and making it so easy, and like you said, you kind of mentioned it's not as simple as an up or down. I guess what's your opinion on that alone? Is this dangerous? Is it neutral? I think you kind of mentioned it towards the end of your book. Like you made an analogy about, was it cars or something, or driving on the interstate, but just because it's there doesn't mean that it's inherently a bad thing as long as it's used responsibly.
I'm guilty of not remembering that one, but it depends on who it's good or bad for. It depends on who we're asking about, right? You can make arguments that it's good and bad uh, for both the users of these platforms, the ones that are trading with the market this way, and you can say that it's good or bad for the system as a whole. I'll argue against it. It's bad for the users in that those that are taking irresponsible risks know they're taking irresponsible risks. Especially nowadays, the way that they use this on Wall Street Bets, you don't go to a casino and lambast somebody for betting on black, right? The guy just wants to have fun and he's got some arbitrary strategy, no matter how mathematically inaccurate it is. They say, well, it's hit red 3 times, it's got to go black next. The guy's having fun and he knows that money is going to potentially be lost on the next play. The guys that are coming into Robinhood with this are doing the same thing. Granted, some people aren't. Some people may have these delusions of grandeur. But the majority of the people, some of the biggest losses that I've seen are from people that have first made the money. There was one example in my book, but there's a bunch of other ones where they make a ton of money, and then actually similar to what happened with you. They make a ton of money and then they give it back. So I don't think it's bad necessarily for them. Do I think it's good for them? I suppose it is. It's teaching them something. It's forcing them to eventually learn about the stock market. I'm willing to guess that if you just kind of went in here jumping into the water saying, I want to short something, but I can't because the broker thinks it's too risky or whatever, and then eventually you keep reading until the point where you get, oh, cool, I can buy a call or a put, and that pretty much settles my thing for whether I want to bet up or down on Tesla. Then after that, you're like, hold on a second. How come if Tesla went up today and I have a call, why didn't I make money, right? And so people ask themselves these questions. And then they have to go out and read and understand exactly why it is that this happened. And then they realize, oh, okay, well, there's all sorts of other factors that affect the price, not just the underlying. It's how how close we are to expiration, what the implied volatility is, what et cetera, et cetera. And so then that forces people to really get engaged. Like, okay, cool. So that means I can also, if it's really expensive, then I can also sell an option, do some kind of a spread, and blah blah blah. And all of a sudden you have these relatively sophisticated trades from people that might not have been there before. As far as a financial literacy, forces people to be engaged. They want to know what the unemployment numbers are. They want to know what the earnings report like, because they want to try and complement their trades with information that makes it more exciting. So that's good. For the system as a whole, I would say that it's not contributing to a problem. I'll say that there's a problem that's always been there, and these millennials are simply shining a light on it. They're doing this in a way that is very crude. They're doing this in a way that is unapologetic. They're having fun with this, and it's arguably not very different from what people have been doing on Wall Street forever. There's an example where one individual figured out a way to get infinite margin, and it got a lot of press attention on Robinhood. It was an oversight on their part, in which they sell a covered call, and they take that money to sell another covered call. That money that when you sell a covered call, that money should be reserved until your position is closed. That's the way that brokers should handle those situations. In this situation, he sold the covered call, he got money, and he was able to reinvest it infinite number of times to the point where he had people, and not him specifically, but other people got up to $1 million worth of leverage. These guys didn't invent the infinite leverage trick. The guys that invented it were the ones from Wall Street. Right? If you go back to 2007, 2008, they had something they called the reverse buyback. And this is where these banks would lend each other money overnight. And then overnight, in order to lend them the money, they would give them collateral to the lender. The lender then has this collateral. In theory, they should hold on to that collateral and not do anything with it until the loan is repaid. But what they did is they used that collateral to borrow money from another bank. And they could do that an infinite number of times. They used fancier words. They did the exact same thing. That is just as dangerous as what these guys are doing. So is it bad for the system? The system was already bad. These guys are simply having fun and shining a light into something that, that deserves a second look.
Do you think that a lot of the current stock market's V-shaped recovery has been large in part due to Robinhood investors and guys that are trying to make, quick money?
Oh, I'm not qualified to answer that, but I'll speculate. I don't think so. It takes an incredible amount of money to move the entire stock market. And granted, if you break down what I call entire, there are a pocket full of companies that are ones that are really driving these market moves. But Robinhood doesn't have enough money. They may have a lot of users, but it takes institutional money in order to make certain types of moves. There was a note. We were on the cover of Bloomberg magazine in March with an article that implied that Wallstreet Bets was responsible for making some wild moves, and this was sophisticated analysis into the effect that buying these what they call deep out of the money short-term expiration calls were forcing computers to buy stocks to hedge their bets, and Wallstreet Bets was essentially forcing the institutional money to do the job for them because they're the ones that actually have the money. If we consider the fact that they trade stock options, in theory, stock options by themselves shouldn't be moving the market. What moves the market is the underlying price. You actually need to buy a market order and hit all the people that have offers, or if you want to sell, you need to sell a market order and you need to hit all the people that have bids. That's what actually moves the price. I don't think there's enough money to do that. Is there enough money to get us some excitement? We saw something with Hertz. A lot of people implied that was the case. Hertz was a very small cap company. I forget what it was at the time, $2 billion. I saw a note in today's Bloomberg and New York Times that retail traders are making up for 25% of the volume that's being traded today. That's an astounding amount of money. Unfortunately, that didn't specify whether it's 25% of the money or 25% of the volume, because that's an important distinguisher. If you have low volume, you can have very little money move prices. If nobody's making trades and you're the only one making trades, you can decide which way the price is going to go. With that in mind, these guys, these guys don't have the money to move. I don't know what Apple or Amazon's market cap is, but it's over $1 trillion, I believe, if I'm not mistaken. That's too much. Can they move a small cap? Can they move Hertz? Probably. There's probably not a whole lot of volume with that, and $2 billion. If you decide to say, hey, 25% of Hertz is $500 million. $500 million. You're taking, I think Robinhood users, 50 million users. 50 million users. You put in $5 a share. I mean, in theory, you could make that argument, but I don't think the market rally is because of Robinhood.
Oh, all right, fair enough. Before I forget, speaking of users, so on the back of your book, it says that the community had over 800,000 subscribers, Wallstreet Bets, that is. Surely you're over 1 million now, right?
Yeah. I haven't checked. Probably last I checked, it was 1.3 million. But yeah, when I wrote that cover, must have been around January or maybe December. So yeah, we've experienced some pretty strong growth. I think that the growth has been going up pretty consistently over the past couple of years. It definitely went up with the advent of Robinhood, and even more so when they started offering stock options. And now that everyone's been stuck in quarantine, we've had even more growth. So yes.
Yeah, I thought that, just the timing of the book release and all the press and everything kind of coming together, and coronavirus, like it couldn't have been better. So you wrote it at a good time, to kind of help explain to people, kind of what's going on and what they're seeing and stuff like that. What is some of your history as far as an entrepreneur? In your book, you said that you were a serial entrepreneur, but I don't know much about the history of some of these companies that you've started. So fill me in on some of that if you could.
Sure. So I studied computer engineering as well as economics from the University of Illinois. Straight out of my undergrad, I started a tech company with 4 other partners that were scattered around the world. It was a tech company that at the time it was using cutting edge technology to provide technological services to businesses. That company, within 2 years of founding it, we sold it to a larger company that was in the same market as us. They just serviced larger clients. I stayed with them for a couple of years to integrate as part of the acquisition deal. Then I moved my way over to I got very interested in finance at the time, so I started getting into these financial services businesses. I did work for a while at a big international bank, which is the opposite of a startup, right? This is almost quasi-governmental with very bureaucratic, very bureaucratic environment. And then I decided that really wasn't for me, so I went back to the startup. I moved to Mexico about 6 years ago. I helped start a car leasing business, a very specialized car leasing business. I was a CFO for that, sold that business. Then I started a consulting business for companies that are of all stages that are looking to raise funds. These are venture capital, investment, private equity, debt, you name it, government grants, etc.
Is that kind of primarily what you're doing now?
Yes.
Okay. All right. And I saw on your website, I haven't looked if it's still there. I'm assuming it's probably gone, but you were trying to set up a convention for the later part of this year where it was going to be like the first of its kind, like almost like an eSports environment where we're going to bring traders to do live trading. Tell us a little bit about that and kind of that idea and that convention and that business plan and kind of, just fill us in on that.
Yeah. So the website's it's still at WallStreetBets.net. So I'll give you guys an update with that. So I decided probably around sometime last year that the tendency where everyone was taking trading, once again, this is before coronavirus, they were starting to treat this like a game. It's a gamified experience on the phone. You have the confetti animations. You have people that are using game lingo. They're using, I'm going to make bets. I'm going to do this, that, the other. And you have a very strong rise in eSports. There's, to me, the most fascinating thing about eSports is not how big it is. It's how big it is and how isolated it is from people that are not into eSports. There's more viewers that watched the League of Legends, was it last year, 2 years ago, than they did the Super Bowl. There's a huge demand for it. And there's a huge rise to it. So I said, look, these guys are already treating this thing like a video game. Why not make an actual event where we have a competition or a championship where we follow the video game format? And so we rented out the largest esports venue in the U.S. There's others that are under construction that might be bigger, but for the moment, we rented it out and we announced that we were going to have a 3-day live competition with real money where these contestants go in, they deposit money into their own account, they trade their own accounts in over 3 days to see who's able to make the most amount of money, or some people joke about who's going to be the last to lose their money. And to broadcast that over the internet, as well as having a live audience that can watch that. I think that it was a logical next step. Unfortunately, I think the world kind of got stopped in their tracks, and you can insert this was my plans for 2020, and this is what happened, right? So that kind of stalled a little bit. It's still not gone. The problem that we're facing is, especially because this place is in Texas, we need to have coronavirus. We need to be able to have this event in the stadium. And so at this point, it's every other week. We're still trying to decide whether or not. And unfortunately, part of the framework in order to pay for something like that, as you can imagine, it's very expensive, is by selling tickets to have an online, a physical presence in there. So that changes the entire equation. With this uncertainty, basically what we're left with is, I still want to do this. We still want to. There was a tremendous amount of interest. There still is a lot of people that go online and they ask for information. So we've decided to push this back until April. So this is a 6 months from the original date. This was going to take place in October of this year. Now it's going to take place in April of next year. And more likely than not, it's going to be entirely online. This is where the tendency of everything is going anyways. And so that'll make us more insulated from whatever happens with coronavirus. Everyone's stuck at home anyways. All TV broadcasters are doing this thing from their house. People can compete from home. And so it's just a matter of figuring out all the logistics. Obviously, it really changes heavily the entire logistics of the operation. But for the most part, the spirit of it continues to be there. The interest has grown tremendously because of coronavirus. So in that sense, I'm somewhat thankful. We have Dave Portnoy, day trader from Barstool Sports. Obviously, that was a very logical step for him, given that there's no sports anymore. He's bringing all sorts of attention to this market as well. And so that's pretty much where we stand.
Well, okay. I mean, I'm glad to hear it's still going on. I'm in Texas myself, so I'll be looking forward to that event. I'll definitely do my best to try to make it out there for that 3-day event. Or I don't know. Like you said, you're doing it online, so I guess we'll see. Yeah, I guess Dave Portnoy. I mean, I don't know. Do you have any comments on that and just that phenomenon of the Portnoy effect, as they call it?
Yeah, I really like the guy. I identified really early on.
He's a hell of a marketer.
Of course, yeah. No, he's very good with that. And I identified super early that this coronavirus is going to push him into the sport. So I actually went on his show at the beginning of this because I wanted to meet him and establish a relationship with him. To see if maybe there was some synergy there for this competition or not. But for the most part, I think he has single-handedly done what the entire Occupy Wall Street movement tried to do. He's done it in a couple of months, and they took I don't know how long it lasted, but it feels like at least a year. He has forced the mainstream Wall Street pundits to talk about him. He's forced the Wall Street Journal to talk about him. What he does, you can argue, is not all that different than what takes place on WallStreet Bets, but what makes him different is that he's doing this for entertainment purposes. I think that now he probably enjoys it as well, and now I forget if he's making money or not, but he can also make money with it. But I think originally the idea was just, let's provide people with some entertainment and let's have fun with it. The guy's personality is obviously well suited for that, and he's got such a strong audience and followers that the news couldn't help but talk about him. There was a situation here where he goes back and forth with the guys on TV, and somebody from TV said that he's just taking random companies and investing into them, and then he turned around and bought a Scrabble box, and he literally just shook the bag and pulled out some numbers and invested in that company to say, yes, that's exactly what I'm doing, and that's exactly what everybody else is doing as well. You guys, meaning, he's referring to what he calls the suits. They do all these fancy analysis. They do these crazy research into whatever idea they're going to do it. And he says, look, I just made some money. Like this is This is no different than what you guys are doing. And he sent that one tweet that caught my attention, which really made me smile. There was a week or two ago when the markets really took a hit and he clearly lost money. And he said, "Hey, I lost money today, but the difference between me and the suits, meaning the guys from Wall Street, is I lost my own money and none of yours. The guys from Wall Street will lose your money and none of theirs." And that's really what made me realize this guy really did bring the conversation to a different level, because he has a point. If Wall Street has a bad day, if the banks have a bad day, the ones that lose money are not the ones that work there. It's the people's money who they're playing with as well. And so I appreciated that honesty that he has.
All right. Well, I am personally looking into kind of further my career into finance. I'm thinking about being a financial advisor. Do you have any advice for me?
Once again, I don't think I can speak to any authority as to any responsible financial advisor being the founder of a firm that prides itself on gambling. I guess I'd wish you luck. I think that a lot of the experience that you can learn by actually trading and by actually getting your feet wet with this is probably invaluable. I think this goes for both individuals as well as companies. You have things that happen on textbooks. This is when you go to class or you take a test and you read and you memorize these things or understand these concepts. And then you have what takes place in real life. And they're not the same thing. You will not find a textbook that describes what negative oil prices look like. And even less will you find the mechanics behind stock options designed to work with negative oil prices. That is, you can buy call options for something that has a negative value. There is no literature for that, right? You need to be able to have such an innate understanding of the mechanics behind these things to be able to say, okay, I got it. I think the way they're going to do it is if this strike price does this and then blah, blah, blah. Obviously, because when you're selling something, when you're going long a stock option that's paying you money, it almost feels like it's shorting it, because that's what happens when you sell a stock option to open your position. So it's probably invaluable to have that. And I said that it's important for individuals as well as businesses, because businesses, I think, learn that too. You have, and I guess I'll bring up Robinhood. They're the easiest example because they're such high profile, but I have no doubt it happens with everyone else. It definitely happens with E-Trade, as I put it in my book. These guys decide to make a broker. They say, let's offer stock options to these guys. Let's go ahead and hire a guy that's just graduated from college and knows about these finance things, and he'll tell the programmers what to do with the program. So then the finance guy says, okay, well, here, a stock option, when you sell a spread, right? That's when you buy let's call it a bull spread. When you buy a call that's with a certain strike and expiration, and you sell a call that's spread expiration, you can graph that and say that I have a maximum loss and I have a maximum gain because this call is going to afford me this, and then this long call is going to afford me this, the short call is going to afford me that. There it is. There's no way I can lose this amount of money, or the most that I can lose is that amount of money. And then what happens is people come in and they do an early assignment. They exercise their options early. Something that doesn't make rational sense. The economists will say, well, nobody's going to exercise their stock option before the expiration because then they lose money, blah, blah, blah. And it's not convenient for them. But they don't realize that in the real world, people do that much, much, much more frequently than you would think, based off of what people's logic is. And so stockbrokers themselves implement these. They allow people to use these things. And then they end up losing money too. They end up being on the hook for these tremendous amounts of monies. And they scratch their heads and say, well, how come we lost money? Because this guy said that the most you could lose was this, and now his account balance is negative. And they obviously have to foot the bill for that. That experience is only by somebody that said, dude, most definitely they can and they will exercise, because of this and that and the other. So I think that the hands-on experience is going to be something that will complement pretty much any professional in this field.
Well, thank you for that advice. Jaime, I'll let you go. I just want to remind the viewers one more time, Wallstreet Bets. The book is out. Go and check it out. It's a real good book. Jaime, where can people find you?
They can find me on Twitter. That's at WallStreet Bets. That's all 3 words spelled out. They can find the book on Amazon, and we have the website for the championship is WallStreetBets.net, and then I also have another website where I post all my ideas and blogs at WallStreetBets.org that I put articles here every couple of weeks on there.
Okay. Well, Jaime, thank you so much for your time. I really do appreciate it. Hope we can do this again soon. I'll be following you as always on Twitter and all that stuff, and on the group itself. Thanks again, and hope you have a good day.
Thank you. Had a good time, Jeremy. Have a good one.
Thank you.
Take care.
Bye-bye. Thank you guys so much for watching. Let me know down in the comments below, what was your favorite part of the interview? What questions would you have asked Jaime yourself? What'd you find out that you liked interesting? Let me know down below. Be sure to hit that thumbs up and subscribe if you haven't already. And be sure to check out some of these other episodes. We'll post them right here and right here, or you can click on my face to visit the rest of the channel. And until next time, guys, take care.